We're awaiting FOMC minutes tomorrow after Fed Chair Jerome Powell addressed concerns over rising levels of corporate debt yesterday. Let's watch.
As of now, business net debt does not present the kind of elevated risks to the stability of the financial system that would lead to broad harm to households and businesses should conditions deteriorate. At the same time, the level of debt certainly could stress borrowers if the economy weakens.
We have Danielle DiMartino Booth, a Quill intelligence CEO and former advisor to the president of the Dallas Fed. And Danielle, we just heard what Fed Chair Jerome Powell was saying yesterday. And when we talk about corporate debt, there's some people that are equating it to the subprime mortgage crisis. There are others are saying that, hey, there's actually not that much to worry about here. What do you think of all this?
Well, I think the excesses are kind of in our face. We've got total business debt because we've had so much leverage lending and other kinds of lending that's not necessarily smack in that corporate debt bucket. But when you add it all up together, in 2009, we hit a high of about almost 74%. We're over 73% today. So we're back at that excessive level. Mm-hmm. The problem is there are fewer protections. You've read about covenant-light lending than there were before. And it's also a matter of the fact that it's gone global. And that was the problem with the subprime crisis, right? The first time we saw subprime problems pop up was in some German Landesbank, which we didn't even know what they were at the time. They were small commercial real estate banks. So what I see is the ability for there to be a daisy chain because there's so much of it, and we don't know all that we need to know about it. And so much as in private equity, which the Fed does not regulate, just like the Fed did not regulate a lot of the subprime lenders. I see far too many parallels.
Well, I mean, put this in terms for us, just because we've been talking about the risk that the trade war poses to the economy. Mm-hmm. We've been talking about the fact that could see a potential global slowdown. When you take all that into account, you also take into account corporate debt. I mean, what do you think is the biggest risk to the U.S. economy as it stands right now?
Well, look, we were supposed to be a one and done. We were supposed to have 1 quarter of negative earnings, and it wasn't supposed to go into the second. Now this could potentially, in this current recovery, be the third earnings recession. In other words, 2 consecutive quarters of negative year-on-year growth in earnings. To that, you add this strain of the trade war. We've seen freight shipments go down 5 months in a row. You track that against GDP or any other type of a lagging economic indicator. It's not a pretty chart. And that means that corporations are going to be pressured, and their balance sheets are going to be pressured, and their cash flow and earnings. That's not a good situation into which to add the fact that there's record levels of corporate debt. I think that the Fed needs to be doing a little bit more than monitoring it closely.
Yeah, I mean, when we talk about the two elements of the Fed's mandate, at the one hand, we have the low employment figures. At the other hand, we have low inflation. So it almost means two different things should be happening. What do you think the Fed's next move will be, if you could say it, at this point where it stands right now?
Look, we've seen 14 consecutive months of year-over-year declines in home sales. Home prices have begun to decline in a lot of markets. That is a huge input to inflation. There's not going to be anything transitory or transient, as Powell said in his most recent press conference, about a decline in home prices that's going to end up dragging those inflation figures lower. So not only are we going to have this non-Goldilocks anymore, because you don't want to see these sectors continue to slow, but the Fed's going to have genuine ammunition and reason and license to lower rates as its next step, because it's going to be following inflation lower.
Yeah. One of the other things we've been talking about, just President Trump's attacks on the Fed, or he's trying to influence the Fed. Just from your perspective, I mean, how big of a distraction is that to Jerome Powell and the rest of the Federal Reserve members?
Well, it's, I would say, and I have defended the Fed all along, they're not directly political. They don't answer to President Trump when it comes to making policy. But the fact that the market keys off of what the next tweet is going to be makes it that much more difficult in their position as arbiters of financial stability, because you've got all kinds of asset classes bouncing all around. The high yield market has started to get uncomfortable with this. That is really what caused the Powell pivot back in November and December, was when the machinations in the stock market were sufficient to start to wake up that great big beast in the credit market that we're told we're not supposed to be worrying about.
I mean, real quick, do you expect any surprises in tomorrow's Fed minutes?
No, I think that there will be more talk, because every single Fed speaker on the wires has had the same exact it's as if they're all speaking from the same script. I think that there will be more speaking to the downside risks that they see in inflation, and I think that the market will perceive that rightly as being dovish when those markets hit tomorrow at 2 p.m.
So maybe we could get a rally then tomorrow afternoon. We'll see.
Or another tweet.
Or another tweet. Yeah, that is true. All right, Danielle DiMartino Booth, thanks so much for joining me
Thank
today.
you.